Well, Joe, I think you've got to be very cautious right now. I think having some cash on the sidelines is a good thing to do. I think the appreciation play is not where to be right now. We've seen the high-tech stocks, the FANG stocks, get hit pretty hard. It's been very tough to find places to hide. Even in the bond markets, we've seen treasuries up a little bit recently, but we've seen credit, meaning corporate bonds, mortgage bonds, high yield bonds, widen out versus treasuries, and I also think this is a rather large concern.
You make some points that the return to normalcy that the Fed is trying to orchestrate might be illusory because we don't know what normalcy is. And you point out that, for better or worse, you might disagree with what they're doing. Obviously, we have the divide in this country. But Trump and President Trump and the Republican Congress were trying to spur growth with deregulation, tax cuts, and other what they think are pro-growth policies. And in your view, in much the same way President Trump said, the Fed was sort of working against what they were trying to accomplish. But normally, in a strong economy, you do see rising rates, and that can be a good thing. Why do you think this time around they should stop at such low levels?
Certainly, Joe, I'll be happy to respond to that. There's been no normalcy for the last 10 years since the Lehman bankruptcy. The major central banks of the world created an economy which was the size of the United States, around 21 trillion, but it's really a free cash flow in excess of $100 trillion. The move by the Fed, I think, has been too aggressive to raise rates too quickly and too much, and I think this is beginning to have a major negative impact on both the debt and the equity markets. I think Chairman Powell needs to reassess what's going on and to either stop for a while or just say, you know, we're going to relax our position. But I think that the Fed is a major cause of the disruption in both the bonds and the equity markets. You know, the Fed was created by the Federal Reserve Act of 1913 by Congress. The Fed is the central bank of the United States. The Congress and the President have done everything possible with cutting back on regulations, with cutting back on taxes to grow the economy. And by any matrix you want to use, they've succeeded. And the Fed has gone in exactly the opposite way by keeping raising and raising rates. And I think the prudent thing for the Fed to do at this point is just stop for a while.
I guess people would argue that that's the time you raise rates, when you can. And that's the time, you know, they even say that about, you know, trying to deal with some of what they see as inequities in world trade. Now's the time with it. But now we see the downside to higher rates and trade wars. And that's, at this point, it's 9% from highs in the Dow. It's not the end of the world, obviously. But there's some people like things that just keep going up all the time. And, you know, happy days are always here, but we know there's periods like this. I just wonder if it's worth it. Do you think because the debt level is so high right now that 3% is like the new 7%? I mean, when you think about the debt service, when it just goes up a little, when this much is outstanding, that takes a lot of cash flow to cover, I guess.
Well, right. The cost to the United States government as interest rates rise, which the Fed is causing, goes up and up. So the debt portion of the government's GDP keeps rising because of the higher and higher interest rates.
And you wonder, if they're really, you know, there's arguments about where inflation is. What's the real rate right now? If you were confident that inflation wasn't a problem, then you don't necessarily need to just do it sort of just because you're used to raising rates in a strong economy. You should really use inflation to measure where you set rates. There's no reason to try to choke things off before you need to.
Right. That's exactly right, Joe. You're 100% right on. And the other issues we have to deal with right now, of course, are the tariff wars with China. While it's not talked about much, I'm very concerned about Italy. Today's the day when the European Commission is going to respond to Italy's refusal to cut back on their budget demands. And it could be They say something today, by about noon, it could be they put it off till their finance minister's meeting January 22nd. But there are these headwinds out there in the economy, and there's just, in my opinion, no reason to be raising rates right now on some theoretical basis, which of course also cuts into consumer spending, what people are going to spend at Christmas in retail and so forth and so on, if you just keep having this expectation of ever rising rates.
And Mark, just playing into what you just mentioned, the EU did just open disciplinary procedures against Italy after rejecting those budget plans that you talked about.
Right, let me explain why I think this is so important. You can look at Italy and say, well, Italy's way over there, it's in Europe, but here we have an issue where if Italy and the European Union get into it with each other, which I suspect is going to happen, this could have a major impact upon the relationship between the dollar and the euro. And if it gets bad enough, it could even call into question the survival of the European Union. And I don't think that's a tailwind. I think that there's some real question here. And then, of course, you got Brexit going on at the same time, and we may see the dissolution of the European Union as a result of all this.